We've got breaking news. The 10 trillion Vanguard giant is about to enter the spot XRP space along with Bitcoin, ETH, and Solana. They have 50 million customers, and those customers will have access to buy spot XRP starting tomorrow. This video is going to come out on the 1st, so you're getting this before it even happens. Let's jump straight into it because this changes everything. Vanguard, the most stubborn holdout, the most anti-crypto of all the legacy giants, has finally caved. They will now allow spot crypto ETF trading on their brokerage platform, including Bitcoin, ETH, XRP, and Solana ETFs. Boom! However, Vanguard is reiterating that they still have no plans to launch their own spot ETFs. Instead, they'll allow their customers to buy these third-party products directly through Vanguard's system. That's the key. And when you grasp what that means, you start to see how big this moment really is for XRP. Hi, and welcome back. Hope you're having a great time. Hope. Day out there. If you enjoy staying ahead of the biggest XRP and crypto news before it hits the mainstream, make sure to like the video, subscribe, and turn on notifications so you never miss updates. And if you want to understand how the top 1% position themselves during moments exactly like this, check out the XRP Millionaire Blueprint or upgrade to Millionaire Blueprint Pro to unlock all content access, including the XRP Millionaire Blueprint and the 100x stock formula, plus exclusive weekly insider reports. Life-changing wealth starts with the right strategy. It's pinned below because here's what's actually happening behind the scenes. Vanguard's reversal means XRP is about to gain frictionless mainstream traditional finance access to tens of millions of everyday investors who never touch crypto exchanges, never move money to Coinbase, and never download anything beyond what's already inside their retirement accounts. This single decision turns XRP from a crypto-native asset into a legitimate default-eligible satellite position for conservative portfolios across the country. And when conservative money moves, it moves big. Vanguard will now let 50 million plus brokerage clients trade ETFs and mutual funds that primarily hold select cryptocurrencies, explicitly including Bitcoin, Ether, XRP, and Solana. These products will be third-party funds, but that doesn't matter. What matters is that the door is now open on one of the biggest platforms in the world. And here's the direct implication for XRP. Any XRP ETF or mutual fund that meets Vanguard's listing criteria can now be purchased inside regular Vanguard brokerage accounts, 401(k)s, IRS, workplace retirement plans, and standard investment accounts. That is the difference between a small niche asset and a mass market financial instrument. Most investors never leave their brokerages. They don't go to exchanges. They don't learn MetaMask. They don't set up wallets. They invest where they already are. Vanguard oversees roughly $10 to $11 trillion and nearly half of all U.S. passive ETF and mutual fund assets. Just think about that for a moment. One company controlling nearly half of all passive flows in America, and now XRP is eligible to sit inside those flows. Once you understand what Vanguard's decision actually signals, Vanguard is one of the most conservative brands in all of asset management. They practically invented the low-risk, long-term, no-nonsense investing culture. And when a company like that begins allowing crypto products on its platform, it tells every institution watching, crypto has entered the legitimacy zone. XRP, ETH, BTC, Solana, they are no longer speculative outliers. They are now high-risk satellite assets institutions feel comfortable offering to everyday Americans. That shift is massive. Kajiski's comment that crypto ETFs and mutual funds have performed as designed is even more important. What that tells you is that back-office processes around settlement, liquidity, reconciliation, and administration have matured to a level Vanguard is comfortable with. That means fewer operational fears. It means the pipes of the system are ready, and it means more XRP products, ETFs, structured funds, index blends, multi-asset crypto portfolios can pass internal approval at huge intermediaries far more easily. Now this is where things compound. XRP doesn't need Vanguard to create its own ETF. It simply needs these platforms to allow the ones already approved to flow into their system. That alone changes distribution. But here's where the competitive pressure kicks in. If Vanguard is opening the door, what does that do to BlackRock, Fidelity, Schwab, State Street? These giants compete for customers, retention, product access, and AUM growth. And when one giant steps forward, especially the one known for saying no the longest, the others have no choice but to keep pace. This move creates forced alignment across legacy finance. XRP is entering the mainstream, whether these firms personally like crypto or not. Now, let's put some numbers on it. Vanguard's estimated AUM for 2024 to 2025 sits roughly in the 10 to 11 trillion range. Their customer base is over 50 million, spanning U.S. retail accounts, 401ks, IAS, workplace retirement plans, international clients, 529 plans, and more. One internal program alone, Investor Choice, serves about 10 million investors and nearly $1 trillion. These people aren't swapping on Binance. They aren't bridging to DeFi. They're long-term, conservative, passive investors, exactly the kind of user base that multiplies long-term structural demand. And here's the wild part. This news is everywhere on X today, and yet most people still don't fully understand what it unlocks. Starting Tuesday, Vanguard will allow ETFs and mutual funds that primarily hold select cryptocurrencies, Bitcoin, Ether, XRP, and Solana, to trade freely on its platform. That instantly unlocks distribution to a demographic that was previously unreachable. Now, combine this with the volume numbers we're seeing. Another $40 million in spot XRP demand today. Friday alone, even as a half day, saw $22 million. Assets under management in XRP ETFs grew by another 11 million XRP. We could be looking at 15 million XRP needed for today, and once Vanguard joins the flow, that demand goes up significantly. Exchanges are already struggling with shrinking supplies. Coinbase is reportedly down massively in XRP reserves year over year. Liquidity is thinning and large buyers need large sources. Ripple's escrow becomes a conversation point even though no one wants them to touch it. Add in the macro picture. Millions of new investors entering crypto over the next few years. Trillions of dollars flowing into tokenized assets. The entire financial system migrating on-chain. All of this converges at once, and XRP sits at the center because it was built for the very functions that tokenization, settlement, FX, and liquidity demand at global scale. This is why I always say my time horizon is 2030. If it happens earlier, great. But by 2030, this ecosystem will have gone from a few trillion to tens of trillions, possibly over $100 trillion, including tokenized value, and the chains that provide the core infrastructure will be priced accordingly. OpenEden is one of the clearest examples of the institutional shift happening behind the scenes, and understanding why Ripple is positioning itself around companies like this is crucial. OpenEden just closed a major strategic round that includes Ripple, Lightseed, Faction, FalconX Global, and others. These aren't small players. These are names with global reach, institutional networks, and deep relationships with top-tier funds. And the shared interest across all of them is simple: bringing real-world assets, especially U.S. Treasuries, onto public blockchains in a fully compliant, yield-bearing, institutional-grade format. OpenEden already issues tokenized U.S. bills on the XRP ledger. That's not a hypothetical. That's not a pilot that might happen someday. That is live infrastructure today. And because treasuries are the backbone of global finance, the deepest, most liquid, most trusted asset on Earth, tokenizing them is the gateway to everything else. Whoever captures that pipeline captures the future of on-chain liquidity, cross-border settlement rails, stable coin backing, and institutional flows. XRP Ledger being one of the chains involved in this is a big deal, especially when you realize what the next few years of the treasury market will look like. As the carry trade unwinds and trillions of dollars in treasuries shift hands globally, the demand for new buyers grows. Traditional banks can't take it all. Money markets can't absorb unlimited supply. stablecoin issuers, on-chain funds, tokenized yield products. They are about to become some of the largest marginal buyers of treasuries worldwide. That means more treasuries on-chain. And when you start pulling trillions in US government debt onto blockchains, you need ledgers that can support predictable settlement, high throughput, deterministic finality, and strong compliance hooks. The XRP ledger is built exactly for that. Ripple understands this. Ripple X executives have already explained their long-term vision: support and expand regulated financial assets on-chain. They are not trying to push speculative meme coins, they're trying to create the infrastructure for serious financial instruments, yield-bearing treasuries, tokenized funds, compliant stablecoins, and institutional-grade settlement. That's where the real money is. That's where trillions flow. That's where long-term dominance is built. And with Open Eden, Ripple is deepening its real-world asset stack in a way that very few people are noticing. Now, zoom out for a second because the tokenization picture gets even bigger when you layer BlackRock CK's public comments on top of this. In The Economist, Larry Fink and Rob Goldstein laid out a vision that essentially describes the next-generation architecture of global finance, a world where assets, ownership, and settlement all live natively in digital form. They aren't talking about crypto the way retail investors talk about crypto. They're talking about the operating system of the global financial system, upgraded, modernized, and rebuilt on blockchain rails. Fink and Goldstein explain exactly why tokenization is the successor to the Swift era. It compresses settlement times, reduces intermediaries, lowers operational risk, enhances transparency, simplifies reconciliation, and unlocks new liquidity pathways. For regulators, it means real-time visibility into flows. For institutions, it means fewer back-office costs. For investors, it means cheaper, faster, more secure markets. And all of that requires blockchains that operate 24/7, scale easily, settle deterministically, and integrate cleanly with existing market infrastructure. BlackRock CK is not imagining this in theory. They are already testing it. Their BUDL tokenized money market fund is live. They are exploring tokenized ETFs and multi-asset portfolios that sit directly in digital wallets. These experiments are happening across multiple chains: Ethereum, Solana, Avalanche, and yes, permissioned tokenized platforms like Securitize. The mix reveals a clear truth. The future is multi-chain, but only chains with institutional properties will survive at scale. That's where the XRP ledger stands out. It was designed from day one for high throughput, low fee, cross-per value movement. It has native asset issuance, built-in DX functionality, automated path F finding, payment channels, and deterministic settlement. It's simple enough to be predictable and compliant, yet powerful enough to handle large-scale financial flows. Institutions care about reliability more than complexity. They want infrastructure that behaves the same way every time, with finality they can trust, and without unpredictable smart contract risks that can blow up multi-billion-dollar products. Even more importantly, the XRPL acts naturally as a settlement and FX layer, bridging assets across chains and networks. In a world where tokenized treasuries might live on multiple chains, tokenized funds might live on another, and tokenized FX instruments might live elsewhere, you need a neutral settlement layer that ties everything together. This is where XRP's long-term utility narrative becomes crystal clear. It's not meant to be a meme coin. It's not meant to be a high-gamble speculation chip. It's built to be a bridge asset for the new financial system, connecting these fragmented networks the same way Swift connected banks decades ago, but with real-time settlement instead of messaging delays. This is why you hear people talk about 1,000 XRP, 10,000 XRP, and beyond. It's not because they're trying to generate clicks and hype. It's because if XRP serves as settlement collateral for trillions in daily volume, the asset simply cannot remain cheap. David Schwartz has said it himself. If XRP is used at scale for real utility, the price cannot be low. That's not speculation, that's math. Liquidity requires depth. Depth requires market cap. Market cap requires price. When you connect these dots, the picture becomes obvious. We are watching the early phase of a financial transition that will be bigger than the internet. The money layer of the world is being rewritten. Traditional market rails are being replaced, multi-trillion-dollar assets are coming on-chain, and utilities like settlement FX and liquidity provisioning are shifting to crypto-native systems. That does not happen in a year. It doesn't even fully happen in 5 years, but it absolutely happens within a decade, and the early adopters will be the ones who benefit the most. Now return to the market signals that triggered this discussion. Vanguard allowing XRPFS, BlackRock expanding tokenization pilots, Ripple backing real-world asset issuers, volume pouring into XRPFS, exchanges running low on supply, and global institutions preparing to migrate assets on-chain. These aren't isolated events. They're all signs of the same trend. The world is lining up for a controlled transition into blockchain-based financial infrastructure. Each part reinforces the other. XRP ETFs create demand. Institutional treasury tokenization creates settlement needs. Ripples. Partnerships create legitimacy. BlackRock CK's pilots create competition. Legacy giants like Vanguard breaking their stance create mainstream distribution, and shrinking exchange reserves create scarcity. The path is unfolding in real time, and we're moving toward a point where all of these forces collide at once. Tokenized money markets, tokenized bonds, tokenized funds, tokenized FX, global liquidity pools, and real-time settlement layers, all working together across multiple chains. XRP sits right in that intersection, built for it long before the world realized it needed it. This is not financial advice. What we're witnessing isn't hype, and it isn't temporary volatility. It's the result of long cycle shifts in infrastructure, settlement architecture, and the institutional psychology that drives capital flows. Most people are distracted by price swings, but the ones who build serious wealth zoom out and recognize when the entire terrain beneath an asset is changing. And that is exactly what's happening right now with XRP. You can look across the board: tokenization pipelines, regulatory shifts, FX corridors, liquidity hubs, AI-driven settlement, and the growing acceptance of ISO 2020 compliant ledgers. And you will see one thing in common. The architecture being built today requires assets capable of neutral settlement, instant finality, and enterprise-grade throughput. Those criteria exclude 99% of crypto, but they align perfectly with XRP. One of the biggest misconceptions among retail investors is the belief that transformative moves in price come from sudden announcements. That's almost never how it works. The real moves come from structural conditions that mature over time and then get triggered all at once by a catalyst. Consider the environment right now. You've got central banks accelerating their digital currency pilots. You've got programmable money use cases moving from theoretical to actual implementation. And you've got corporations demanding real-time settlement to unlock dormant liquidity. In 2020, those ideas were future talk. In 2023, they were in pilot form. But by 2025, they're turning into corporate mandates. When you zoom in on the payment and liquidity bottlenecks facing multinational firms, the logical conclusion is simple. The existing system can't handle the next phase of globalization. Something has to fill the gap. And for institutions, that something can't be a speculative toy. It has to be a compliant, scalable, well-understood asset with a high-trust settlement network. That is the exact profile of XRP. And let's be honest, if you followed the XRP story for years, this is the moment everyone was waiting for. Not price spikes, not hype cycles, but the structural alignment. Think about the developments that were happening quietly behind the scenes. Liquidity aggregators integrating XRPL rails. Cross-border ODL corridors coming online without fanfare. Multiple jurisdictions refining their crypto frameworks to separate payment tokens from investment tokens, which places XRP in a far friendlier regulatory category. Major institutions joining the dialogue around decentralized liquidity models. None of that is coincidence. It's positioning. The top 1%, the deep pocket players, position long before the public sees the effects. They move based on structural inevitabilities, not headlines. This is why the recent volume trends matter so much more than people realize. You're seeing gradual but undeniable increases in organic transaction throughput, not tied to retail speculation, but to sustained corridor activity. You're seeing wallet distribution becoming healthier, with more mid-sized holders accumulating. You're seeing long-term dormant wallets waking up, not dumping, but reallocating. It looks exactly like what you see before a market transitions from accumulation to markup. And if you're someone tracking on-chain data, you already know long-term accumulation phases don't last forever. They end abruptly and violently when demand overwhelms circulating supply. You don't get a warning, the move simply begins. And if you're not already positioned, you're chasing. Another massive driver that isn't being discussed enough is the way institutional risk models are changing around digital assets. Up until recently, most risk committees treated crypto as uniformly speculative, but in the last year, that model has fractured. Now you have separation, speculative assets on one side, payment settlement assets on the other, and that single shift changes everything. When institutions start categorizing XRP as digital infrastructure rather than a speculative token, allocation rules change, exposure limits expand, and liquidity mandates become possible. That's when the big money starts flowing. Not hype traders, but balance sheets. This is the wave that the public won't fully understand until after it has already begun. Another underappreciated shift, derivative integration. As XRP index products expand, whether through institutional hedging instruments, yield structures, or liquidity provider tooling, the underlying demand for XRP as a settlement layer naturally rises. Derivatives don't just amplify volatility, they amplify the need for neutral base layer assets. If the financial system is increasingly using XRPL-based liquidity as a backbone, the underlying token becomes indispensable. And the more indispensable it becomes, the higher its real monetary premium grows. Then there's the geopolitical layer. Every major economy is exploring digital settlement options because they want to reduce reliance on intermediaries that slow down trade. Neutral asset settlement is the future. Anyone in global finance knows this, and while governments might move slowly, corporations do not. The pressure for instant settlement is now a competitive necessity. When you combine that with the economic incentives for freeing up trapped liquidity, the argument for systems like XRP becomes overwhelming. At scale, the cost savings are not millions, they are tens of billions annually. That alone guarantees institutional adoption over time. Smart money sees this. You can watch it unfolding in the order books, the corridor expansions, the enterprise integrations, the shifting regulatory language, and the development of tokenized liquidity marketplaces. This is what a real macro setup looks like. Not hype, but undeniable structural force. And as I've said before, the biggest gains don't come from chasing moves. They come from positioning before the structural catalysts ignite. So, as we close this third section, the real question is simple. Are you thinking like retail traders hoping for a headline? Or are you thinking like serious wealth builders who understand that major moves begin far below the surface long before the public recognizes what's happening? Because this is that moment. The shift is already underway. The groundwork has already been laid, and those who understand the magnitude of what's coming are preparing accordingly. And if you're someone who wants to learn exactly how the top 1% position themselves during moments like this, how they think, how they build conviction, and how they identify asymmetric opportunities before the masses, then this is where you take the next step with the XRP Millionaire Blueprint, or upgrade to Millionaire Blueprint Pro to unlock all content access, including the XRP Millionaire Blueprint and the 100 times stock formula, and get exclusive weekly insider beta reports from the Pro membership.